Welcome back, everyone. We have an exciting episode to get into. We're going to be talking about stocks to buy now. In particular, 5 different stocks on the website Barron's. Now, Barron's is both a news publication, so they just have your typical stock market news, but they're also stock pickers. A section of their website is dedicated to doing analysis and picking out good stocks to buy. And recently, over the past couple of months, they've outlined their thesis on 5 main stock picks. In this episode, we're going to be taking a look at each of them. I'll be reviewing them. I'll be cross-analyzing them with my software Qualtrim, looking at the fundamentals of these companies, and seeing if they match up with the thesis that they outline. So this is going to be an interesting one where I'm looking at other people's analysis and seeing whether or not I agree. I think this is going to be a fun episode. Let's go ahead and jump in. Number 1, we have it right there. It's Carnival. Carnival Cruise Line. Buy Carnival stock. Choppy market conditions will pass. Shares of the cruise line operator have dropped since the report of earnings last month, and it took a dip. It's worth buying now. Carnival, right off the bat, I think is an interesting one. Now, obviously, Carnival's not some like super high quality compounding machine that's asset light. Cruise lines in general do not fit that category, but not every stock pick has to be that way. Peter Lynch invested in a lot of different methods. He invested in turnaround plays and cyclicals and financials. You can do different styles of investing. You don't have to dedicate to just one thing. And Carnival is an interesting company that goes through cycles. And you know, it's an interesting product. So let's go ahead and take a look at it here. We can first start off just by reading their initial thesis on this company. Carnival has hit some rough waters, but its recent post-earnings sell-off looks like a great opportunity to buy a cruise and its stock on a discount. At first blush, Carnival's fiscal quarter earnings reported March 27th, so that was just recently, have been a reason for celebration. The company reported a loss of 14 cents a share, better than its own guidance of losing 22 cents a share, and the 18-cent loss that the analysts were expecting. So even though you might look at this and say, that's bad, they're losing money, right? Their earnings per share is negative. If they're priced to lose 18 cents and they lose 14, that is a beat over what the street is expecting. Carnival also said it would earn 98 cents this fiscal year, 5 cents higher than its previous guidance, and that it will be its first profitable year since before the pandemic. So that's good news. We're getting back to true profitability for Carnival after the pandemic hit this company. The pandemic had an outsized effect on some industries. The cruise industry was one of them. It was devastating for the cruise industry, but they are bouncing back fast. Now, they say with the stock currently down 17% on the year at $15.34, Carnival stock looks worth buying. Carnival is successfully navigating unexpected headwinds and delivering yet another strong quarter. So their thought is the stock is beaten up, but they're navigating it better than investors are expecting. They go on saying that over the next few years, Carnival should generate several billion dollars in free cash flow that will be used to repay debt. So the thought is here that they're becoming profitable this year, real profitability this year, and then over the next few years, as they get things back on track, their debt will be reduced. Now let's go ahead and take a look at this stock here. This is going to be using Qualtrim.com. We can type in ticker symbol CCL, I believe it is, Carnival Cruise Line. And by the way, this website's available to all Patreon members. We have a free trial. If you join today, you get the rest of the month for free. But we're looking at Carnival Corporation here, and the numbers do look cheap. 15:4 PE ratio, 7% free cash flow yield. Now again, this is not a high quality company. I would not put this in the category of a compounding machine. So you kind of get what you pay for to some extent, but even for a cruise line, this does look pretty cheap. We have the numbers right there. It's down 14% year to date. If we zoom out a little bit, we can see the devastation of the pandemic. So once the pandemic hit, all the cruise lines sat there and they still had a lot of expenses while having no revenue. So imagine you're a big business that has all of these expenses continuing with all the expenses, but the revenue goes to zero. That was basically the situation of the cruise lines. So the stock price went down from $49 to $10. And ever since then, it's been almost entirely flat. The big reason why, as they outline, is the debt of the company. So if we look at the balance sheet here, we can bring it up. You can see what happened. Since the pandemic, the balance sheet took on a lot of debt, and they've been working at paying down that debt. Now, if we zoom in the past 10 years, we can see this a bit clearer. The debt stacks up right here. And then over the past 3 quarters, they've been paying it down at a steady rate. So it went down from $31.7 billion to $27.4. So they're selling off ships. They're also increasing free cash flow, paying down that debt. And that's what the analyst is saying here, that over the next couple of years, they will generate growing amounts of free cash flow. They're going to pay down the debt. Paying down the debt is one of the biggest things for this company. It'll strengthen their position, make it so that they're less concerned about interest rates or anything like that. So that's obviously a big catalyst for the company if they can get the debt reduced. Now, another thing we can look at is the free cash flow of the company. We have that chart right here. Cruise lines were never great businesses, but at least it was generating cash consistently before the pandemic. So we can see in 2015, we have 2.2, 2.07 in 2016, 2.38 in 2017. We know that this company can generate real free cash flows, but the pandemic hit and we had negative $9.9 billion in free cash flow. This is where we took on all the debt. So huge hit to this industry, and now it's in recovery mode. Now, one of the things that they mention here is the continued ongoing demand of cruises. Cruise strength is very strong right now. People are wanting to go on vacations, they're wanting to have experiences, and they're picking cruises because cruises have somewhat fixed costs. You just get on the cruise, and once you're on it, there's not too many other expenses. They say, quote, with cruise lines, you have the visibility about a year or so. So we know demand is there for the full year of 2024. So they can basically look at their bookings, how many cruises people have booked out about a year in advance, and they know they have strong demand for the entire year. So if you're investing in Carnival today, you can sit back and know that at least for the next year, there is a lot of demand. So overall, when I look at their first pick here, Carnival Cruise Lines, I don't see too many companies with growing revenue, growing free cash flow, growing earnings, the debt on the company going down and the margins going up, where the stock price goes down too much. When every basic metric is moving in the right direction, it's difficult for stock prices to go down too much. They have to be dramatically overpriced, which Carnival doesn't look like it's dramatically overpriced. So this first buy rating, even though this is not the type of company I would put in my portfolio, I overall think it's a good pick. I agree with Barron's. I think that investors can get gains here. Number 2, we have Hershey's. So let's jump into their thesis here. They say surging cocoa prices have hit Hershey hard, but prices won't stay high forever. It's time to buy the chocolate makers beaten up stock. Now, I've heard a lot of pitches for Hershey's because the stock is a defensive one. It's a consumer staple. It's sold off a lot, but I've not heard one on the basis that cocoa prices have hit the company and you should buy it anyways. That's not ever been the thesis that I've been pitched for Hershey's. Shares of Hershey's have dropped 23% over the past 12 months, underperforming the S&P 500 index, which gained 31%. The problem, the price of cocoa, which comprises roughly a fifth of Hershey's cost of good, has more than tripled. So the price of cocoa is going up like crazy, and that's a huge input cost for them. It's tripled over the past year, squeezing the company's margins and causing investors to flee its typically stable stock. Cocoa rise has been extraordinary, as it approaches $10,000 per metric ton. It is now more expensive than copper. The run-up has been driven by supply constraints in Africa, as dry weather and wildfires reduce the stock of beans available for sale. They say at some point along the way, though, the mechanics of futures tradings took over, causing the price to more than double during the first 3 months of 2024, its best quarter on record. To Walter Zimmerman, chief technical analyst, he says that signals a sentiment that is extreme. The cocoa market is clearly overheated. So this is an interesting thesis. They believe that Hershey stock has gone down artificially because one of their input costs, which is cocoa, has technical analysts bidding up the price of it, making it super expensive, and that's an overheated market. So Hershey's is down artificially because of the price of this input cost. And I think the thought is here, of course, this won't last long. Eventually, the price of cocoa is going to go down, and the futures markets will settle down for this. They say it's unlikely to stay that way. See, obviously, with these type of extreme commodity price changes, they're gonna flatten out over time. Commodity prices tend to overshoot in both directions, whether it was a surge in silver prices in 2011 or a tumble in oil prices in 2020. Extreme moves reversed and suddenly. It didn't matter that there was no catalyst. The outside moves became the reason. In a recent note, Citigroup analyst Akashi Doshi cited a spike in grain prices following Russia's invasion of Ukraine as another example of the extreme move that eventually reversed. So the commodities market has all these extreme moves. We're seeing one of them right now that's impacting Hershey's, and they think it's going to reverse. But high prices bring fundamental changes. In the case of cocoa, the industry is likely cutting back on its use and dipping into reserves, while waiting for new crops to come to market. Doshi writes, "Our base case remains that cocoa terminal prices will enter a bear market by the end of 2024. So I really like the thought here. One of their major input costs is artificially inflated. It's not going to last long. It's going to go down the end of this year. When it does, it'll raise Hershey's margins and the stock will go up. Very simple. I also like the fact that even if that doesn't work out perfectly, if cocoa prices stay higher for longer, you're still owning a good company. You still have the base and the foundation of Hershey's, which is a decent company. It's trading at a 24 PE, a 4% free cash flow yield. And when I look at the fundamentals of Hershey's, it's very strong. There's some other concerns I have about Hershey's that they don't mention here. For example, I don't think the only challenge for Hershey's is just cocoa prices or input costs. I think Hershey's faces competition with private label brands. Things like Kirkland Signature, Good Value brand. All the grocery stores and retailers make their own chocolates as well. Another thing that Hershey's is facing is new competition from social media. You know that Mr. Beast gets 200 million views per video. 200 million. Basically, every kid across the US and the world is viewing Mr. Beast every single week. And in every video, he plugs Feastables. Now, I've tasted Feastables. I don't personally love them, so that's one person's opinion. But that is a lot of exposure to a direct competitor to Hershey's. And as Feastables gets on the shelves of Walmarts and Targets, it takes away a little bit more space for Hershey's. So that's another potential issue for them. I don't think that that's a big problem, but it's just something else that I think investors are looking at. And number 3, what do we have here? We have what looks like a commodity company. Anglo American stock is a diamond in the rough. 2 reasons to buy. London-based Anglo American is one of the world's leading diversified mining companies producing copper, iron, ore, diamonds, platinum, and other metals on 6 continents. Its stock, down 24% over the past 12 months, hasn't performed like one. Operational problems and tough conditions in several key markets, including diamonds, where the company's De Beers unit lost money in 2023, and a disappointing multi-year production outlook late last year have rattled investors and depressed the shares. So it's a commodity company that does mining of all different types of precious metals and commodities. And they've had a tough year over the past year with operational problems. Now, this issue that this company's facing highlights one of the big things I look for with my companies. They highlight operational problems. One of the things that I look for whenever I'm doing analysis in a stock is the operational complexity of running a business. I like companies that are nimble, they're capital light, they're maneuverable, they can adapt to any different environment, they can price different products any direction. They're not operationally complex businesses like this one. This one seems like a very operationally intensive, complex business that has lots of capex and operations around the globe. Compare that to a company like MasterCard. This is one of my biggest investments. This company is nimble, it's light, it can maneuver, it can change, it can go in and out of markets, it can change pricing because MasterCard has no people mining in different parts of the world. So these are different businesses that have different implications. You're not going to run into these type of operational problems with MasterCard nearly as frequent as you are with mining companies. So that's a big factor into what I invest in. But in some cases, like they highlight here, this can bring up opportunities. If the company gets into trouble, you can buy the dip and have a recovery. Anglo American's future, however, looks bright. Metals pricing are improving, and the company is vowing to cut costs and improve operations and make strategic reviews of all of its businesses, including a capital-intensive fertilizer project it's building in the United Kingdom. Nothing is off the table, says the CEO of the company. That could even mean a sale of a $30 billion company, which could be easily digestible by one of its competitors. So the basic thesis from Barron's is they found a commodity company going through operational challenges because it's an operationally complex company that's very capital intensive. They have these big sites that they have to dig and mine up these precious metals. Well, of course, they run into rough patches once in a while. The stock has sold off. The CEO is dedicated to turning it around. So it's a turnaround story, and it could be a potential acquisition target. Now, in these type of unique situations, I think it could possibly play a role as like a small one-off in a portfolio, but I don't like these type of investments. I would never buy this stock on that thesis. I think it's very risky, very questionable, and I think that these type of companies go on dips so frequently because they have so many frequent challenges. The commodities market is incredibly volatile, just like they said with the cocoa market. Goes up like crazy, goes down like crazy. It's not something that's dependable or reliable. In my portfolio, I'd much rather own the company S&P Global. S&P Global has the Platts business. The Platts business is like the indice business of commodities. So S&P Global sells data about commodities to companies like these. They have them as clients where they pay for all of this data, and other companies do as well. So S&P Global makes money from these companies and this market without having the volatility of this market. And I think that's a much better route. I like companies that are capital light, they have recurring revenue, they can grow earnings year over year. So this might be a good recovery play, a potential short-term investment, but it's not my favorite pick. Next up, we have one that I think a lot of people will be happy with, which is PayPal. The name PayPal used to be ubiquitous with online payments, and the company had growth to prove it. Its Venmo service, for example, was especially popular with younger users, while using its namesake service was a default choice for many while shopping online. But Apple and Alphabet's Google ramped up their own payment options, and other companies ventured into the space. As online shopping cooled following the pandemic, that growth evaporated. PayPal was forced to pivot to less profitable products, such as providing white label payment services to online companies. I think an accurate depiction of what happened. PayPal was basically like the market for online payments, right? Digital payments. And then Apple and Alphabet came in and they used their muscle, their big network effects to muscle into that category quite successfully. That pressured PayPal's gross margins, which dropped from 45.8% in the fourth quarter of 2023 from 55.9% in 2020. Now, again, I've looked at a lot of companies. I've been in the market for a long time, and I rarely see companies go up in stock price when their margins are dropping. I just don't see it. And the inverse is also true. I rarely see companies going down in stock price as their margins are moving up. It just doesn't happen that frequent. So as the margins dropped, of course, PayPal stock price did dramatically. And this was an epic sell-off for PayPal. Its shares plunged 80% from the peak of 2021. The bad news is that PayPal will never return to the growth of old. The good news is that it doesn't need to. With the new CEO, Alex Chriss, leading the charge, change is coming. Change that should help reverse the recent weakness. The company is becoming leaner and more focused. They say that PayPal is trading like a coal mine that has a finite life, and it won't take a whole lot to get it re-rated, meaning the multiple will move back up. So their thesis of PayPal, I think, is pretty mainstream. That's how I understand it from most PayPal investors. You had PayPal dominating up until 2020. Then you had Apple Pay and Google Pay take a lot of market share. PayPal's margins went down as they ventured into different business lines. They've had a change in leadership, and the stock prices dropped dramatically, 80%. Now the stock is trading for cheap. Right now it's at a 12.6 forward PE. The market's trading at like a 21 forward PE. So a lot over PayPal. PayPal is very cheap, even compared against the S&P 500. The free cash flow yield right now is 6.07%. Now that's a bit misleading because they do have a lot of stock-based compensation, but it's still around 4% even after factoring in dilution. So that's a very healthy yield for a company. When I look at PayPal, I do agree that the stock is likely undervalued to some degree. So I'd not be surprised to see it go up 20, 30%. That wouldn't be shocking to me. But I don't buy companies on the basis that they're slightly undervalued. I buy them on the basis that they're quality companies that have long tailwinds of predictable growth. I do not believe that's the case with PayPal. I don't believe the company's all that predictable. And when I look at the competitive landscape, PayPal faces all sorts of different competitors in their landscape. So if I'm ranking these so far, my first pick would be Hershey's. I think that's the most reasonable risk-adjusted one to buy. Second place would be PayPal. Third place would be Carnival Cruise Line. Fourth place would be the commodity company Anglo American. Now we have the final stock pick here, number 5. It looks like a logistics company. Shares of South America's Amazon.com looks like a buy. Here we go, the Amazon comparisons. This is always a red flag to me. Anytime I hear that this is the Amazon of this or the Amazon of that or the Apple of this or the Apple of that, I have red flags just going up in my mind. Let me say something here very clearly. The Amazon of this or that is Amazon. There is only one Amazon.com. It is the US's Amazon. And the reason I say that is because, again, you have the Chinese Amazon, you have Pinduoduo, you have Temu, you have Alibaba. All of these companies have claimed to be the Amazon. Everybody wants to be the Amazon because of how good Amazon.com is. The company's amazing. There's no other company on it like anywhere in the world. There's no other company like Amazon. There's no South Korean Amazon. There's no East Amazon. There's no South America's Amazon. The reason I say that is because none of these companies, even though they're advertised that way, and I think it's interesting to look at it as a quick reference, none of these companies have the same ingredients that Amazon has. None of them have the same dominant share of so many mega corporations using their hosting service, Amazon's web services. Amazon has already capitalized on that market. It's gone. It can't be replicated. It's already tackled by Amazon, Microsoft, and Google. There are no more Fortune 500 companies to get. All of them have been gotten by Amazon.com. So right there, there's no other company that can accomplish what they've accomplished. It's already completely decided at this point. There's also no other company that has anywhere close to the advertising built out on their system. Amazon is leaps and bounds above any other competitor. There's no other company that has the same size logistics network as Amazon. None of these companies come even marginally close. So I know that this is more of like a marketing thing. It's not to be taken too seriously, but you hear this frequently on social media, on Barron's, everywhere. This is the Amazon of South Korea. It's not. It's a different company that has different dynamics, that doesn't have anywhere usually the strength of Amazon. And in most cases, the further I look at these companies, the more I realize how incredibly different they are than Amazon. So I realize we're not off to a good start by referencing a comparison to Amazon, but let's go ahead and take a look at what stock this is. All right, they say here that investors looking for an alternative to the Magnificent Seven could do worse than Mercado Libre. And that's the company, Mercado Libre. And a recent earnings disappointment has created a buying opportunity in the stock of the Latin America's dominant online retailer. So basically, this is a really big Latin American retailer, and that's why you have the comparison to Amazon. There's a lot to like about this e-commerce and fintech powerhouse. If the 218 million users of Mercado Libre all lived in one country, it would be the most populous in Latin America. The company's earnings per share more than doubled last year and are expected to climb 80% in 2024. But it didn't stop Mercado Libre from slumping 10% after the earnings report on February 23rd. The Montevideo, Uruguay-based company reported a profit of $3.25 a share and revenue of $4.3 billion. So this is the Amazon of Latin America. That's the comparison. And for the quarter, they reported revenues of $4.3 billion. Let's go ahead and just put that in context here. Let's bring up Amazon's revenue for the past quarter. And this will give you an idea of what the comparison is. So $4.3 billion versus Amazon's last quarterly revenue of $169 billion. So the revenue, if I was to stack them up side by side here, would be like right there. Even lower than that. It'd be barely above. It'd be like right there. So that's this is why, you dig into the comparisons and you go, okay, this is not Amazon. It's a different company in a different market with a different consumer, not in the same businesses with the same customers. But we continue on. Gross merchandise volume and total payment volume, two key e-commerce and fintech metrics, rose 40% and 57% year over year. So we see super fast growth here. Investors, however, were concerned with the decline in gross margins, and tax charges meant income was well above analyst predictions. So even though the revenue is going up quickly, margins going down has caused the stock to sell off. The tax expenses without which Mercado Libre would have easily beaten expectations were a one-time hit, while the company always had planned to sacrifice some margins to pick up market share. So they're saying that this really isn't a problem going on. This is a one-time hit from taxes, and this was an expectation from the company. They were going to make margins go down a little bit to go for land grab, which I think is a good strategy to do. They continue on saying the case for Mercado Libre starts with its ability to succeed where others haven't. Amazon.com is the 800-pound gorilla in e-commerce, but Brazil, Argentina, and Mexico, Mercado Libre's main markets, are small potatoes for the behemoth. That makes it less of a competitive threat to Mercado Libre. So they're basically saying that they're going into these underserved markets where Amazon isn't putting too much focus on. Amazon's going for the more developed markets, the more wealthy countries. Mercado Libre is going for South America, and their competitors just aren't as strong there. They also say that it has a more tumultuous economic backdrop. So they're navigating more economic difficulty than Amazon here is in the US. That may make the region less attractive to low-cost Asian marketplaces like Temu that have made inroads in the US. So this is kind of a company going into this territory that's a little bit less targeted by big e-commerce companies, and they're serving this underserved consumer. Let's go ahead and take a look at the fundamentals here. We bring up the stock and the revenue is growing quickly. This is quarter over quarter. So we're up to $4 billion per quarter and it's growing rapidly. In fact, that growth is around 40% year over year. So we still have very fast-paced growth. Now their free cash flow is basically flat over the past 7 or 8 quarters. I don't think that's a problem because they're clearly going for land grab. They're not optimizing for profits yet. And then we can finally look at the operating margins of the business. You can see it increasing steadily over time. And then the most recent quarter, a huge drop off. And that's why the stock is down. Investors were concerned about the profitability. I agree with Barron's here. I don't view this as a problem, especially if management was talking about this as somewhat of an intended thing. They were willing to sacrifice margins temporarily to gain market share, which they should. So I actually like this pick from Barron's. I'd rank this one in 3rd place after Hershey's and after PayPal. So there we have the 5 stocks to buy now according to Barron's. Overall, I think that they're good picks. I like the arguments for them. They're fundamentally based. But my only problem with them, my only argument against them would be they all seem to be rather short-term focused. Maybe 1-year analysis or 2 years. They're not based on the qualities of companies, the long-term secular trends, the things that will drive value accretion for year after year after year and decades into the future. So you have to know that going in. Barron's is looking at buying dips in companies, having a recovery, and getting out of the stock. They're not looking at investing in these companies long term. So that's a difference in approach than what I do. But overall, if you are the type of investor that you want to take advantage of different dips in stocks, there's nothing wrong with that. And I think these are 5 good options. That's all for now. See you in the next one.